All right, welcome in. Happy Tuesday. This is the Cow Guy Close, and I'm Scott Shellady, also known as the Cow Guy. Thanks for showing up here today. We got a great show in store, so let's get to it, right? Even though we're in the dog days of summer, I use that probably too often, but we are really in the dog days of summer. There are a few things on the horizon that could prove to be some decent market movers. Now, we're in the midst of earnings season, and we'll see a number of big tech firms report, which may move our tech sector. We got a reading on GDP tomorrow, which will have a lot of eyes on it. And last month's reading was around minus 0.05%. And we're expecting to bounce back with a print of maybe positive 2.4%. We'll see. We're going to get to hear from Jay Powell as well as after his two-day Fed meeting. Right now, there's a 96% chance of no change in rates. But the press conference is going to be the top billing there. We're going to want to hear what he's got to say at the second day of that meeting. And finally, we get non-farm payrolls on Friday. We're looking for growth in jobs of around 108,000, so that'll be a key driver for interest rate policy as well. It's a lot to take in, but at this time of year, they could be some significant market-moving numbers. Now, we wanted to hear what our next guest thinks we're going to get in those numbers, and please welcome to the show Mr. Luke Lloyd. He's with the Lloyd Financial Group, coming to us from Covington, Kentucky. Thanks for taking the time, Luke.
Thanks, Scott.
The air is kind of stale. The market feels a little stale. But we do have some decent data dump for the next 3 days here for the last week of July, first day of August. What are your thoughts?
Well, it depends on where you're looking at in the market to see if it's stale or not. And when the NASDAQ is trading at like 28, 29 times future earnings, and you're taking a look at the S&P, I think it's like 24 or 25 times. But then you take a look at the equal weight S&P, the RSP, trading at like 20 times earnings, you start seeing a lot of discrepancies. So if you're looking at like the NASDAQ and the S&P 500, it just seems like to be a bunch of wishy-washy up and down. Like today, the NASDAQ's down a little bit, the S&P is like flatter down. But my clients right now that are more value tilted in their investments are actually up like 0.3%. I think that rotation is continuing to happen because I'm not saying there's going to be a big market sell-off on the aggregate side, but I think that market rotation means that you're going to see a lot of the headline indices like the NASDAQ and S&P be pretty flat, but then you're going to see the catch-up trade happen in these value stocks and the equal weight S&P and even small caps like IWM, the ticker, right? I think that you're seeing that rotation of money. Even international is doing pretty well today. So I think that rotation is speaking a lot of language to a lot of different areas.
Okay, so I was on Varney this morning. We talked about this again. And I would say that, the big, beautiful bill being signed and maybe an interest rate cut in September, more of these trade deals are coming through. All of those things are I would call they're maintaining the gains. They're maintaining the gains.
Yes.
And that's not going to be the next leg higher. I think the next leg higher, and this is going to sound perverse, all right, but hear me out, is that I think that we've gotten to where we are because of the deniers, the folks that traded their politics and sold on the lows in April 8th. And because we still have some big-time deniers, that's fueled the market higher. We're going to need to keep them in there because if they switch to bulls, then this thing's over, right? At least for the short term, I think. So I would like to see a 2 to 5% pullback to embolden the shorts to stay short or
Yes.
at least stay out of the market, because I then think we could see some new highs with that $7 trillion that's been left out of the last rally. What do you think about that?
I absolutely think that's the case. I mean, all the market is and all stocks are is supply and demand, right? It has, we pay attention to earnings. We pay attention to GDP prints like you talked about. We pay attention to jobs data. We pay attention to whether or not the Federal Reserve is going to cut rates or hike rates. But at the end of the day, it is all that supply and demand. And there has been so much money on the sidelines. And like you said, could it be political? Absolutely. Could it be scared? People just scared of the entire environment and people aren't feeling as comfortable because consumer confidence did drop earlier this year. Could that be the case? Possibly, right? So there's all these different factors, but at the end of the day, there is money on the sidelines and pullbacks are healthy, but we just haven't seen, ever since the pullback in March and April of 20%, it's really been a grind higher ever since. We haven't seen like a 5% correction. So we actually do need that to maintain. The scarier thought is actually if we keep grinding higher without a pullback, that's even scarier because when we do have the pullback, it's probably going to be more extreme. But at the end of the day, tariffs are looking like a lot of these things are going to figure it out. We have the deadline coming up in a couple of days. There's there's probably going to be some news headlines, volatility around that. I expect GDP to come in pretty strong. I think we will rebound from there because of some consumer confidence and spending throughout the economy. I think the jobs data will come in a little lighter than usual. I think $108,000 is light, or 108,000 jobs being created this week is going to be lower than it was historically. So we could see some cracks maybe forming there. We need to pay attention to that. We're not going to see rate cuts or rate hikes. I think a 96% chance nothing happens tomorrow. But heading into September, I do think we get the rate cut. I think a 64 or 65% chance of a rate cut's coming in September. That's a big tailwind. And I don't think that's a tailwind for the S&P and the NASDAQ. I think those rate cuts are actually tailwinds for all the stocks I talked about earlier, the equal weight, under the radar stocks that have not performed very well. And frankly, energy stocks and utility stocks, the unloved, boring stocks that need to catch up.
Yeah, interesting. I had somebody at my house this weekend from Chicago, and he's a laborer, and he's in the union, and he does a lot of work, buildings work. But you know what he said to me? He said if it wasn't for all the projects they've been doing lately, they'd be out of business. And I asked him what projects were they doing, and only came to my mind because you just mentioned energy. But they're building data centers hand over fist as fast as they possibly can. That's got to tell you something about the power that we're going to need to power these things going forward.
Well, you just hit the nail on the head. I mean, I think that we are in this perfect scenario and environment for energy stocks and those utility companies where the electricity is created. Like, I think these kind of stocks that are so underweighted in the S&P and the NASDAQ, I think there's so much not money that hasn't flowed to them. And when that money does rotate and flow, you're going to see a rip your face off kind of rally. Maybe not necessarily in the commodities directly themselves, but the actual companies that are making money hand over fist because of the energy and AI demand. I mean, technology stocks, the NVIDIAs, the AMDs, the Microsofts of the world that everyone's rotated their money in the past couple of years that is around this AI. The question we need to ask, are these growth rates on earnings actually going to sustain themselves? Instead of betting on whether NVIDIA can continue to grow its top line revenue at these ridiculous rates, I'd rather bet on the energy demand that we know needs to stay there instead of buying a $4 trillion company that's already run 10 times over, right? So again, it's all about risk and reward at this point. And of course, you can remain in some of the high flyers, but I think there's just more risk at this point when you know energy demand is going to stay. I don't know for sure if NVIDIA's direct demand, if they can even meet the demand for making these chips. I don't know what's going to happen with China and Taiwan, these geopolitical events that could impact the earnings, but I am very confident the demand for AI as a whole and as a macro factor stays, which is why I think you got to be overweight energy and overweight utilities. And utilities actually, I said it needs to catch up. Utilities are actually at all-time highs. It's not talked about, but it's been a great trade for a long time. Yeah,
I mean, if you look at a chart, I mean, the utilities have done well, and you're exactly right. They're the unloved stocks, probably more of the single-weighted S&P. That you're right, and it's been interesting to see how those things have come back to life. Industrials as well. Thank you very much, Luke, for coming on. Luke Lloyd from the Lloyd Financial Group in Covington, Kentucky. Great to have you on. I can't wait to see you again next week, Luke.
Thanks,